Hello students and welcome to the lecture. So students, as we know that we are covering the financial knowledge and the banking awareness part of it, alright? And so far we had completed till the National Housing Bank, alright? I hope that you have revised the previous lectures properly so that you could have a better understanding of the lecture we are going to start with this lecture, alright? So basically, this is the topic we have covered so far, banking awareness, right? And these are the topics we are going to start in this lecture. Okay. So we are going to start with the FMC, thereafter its regulation, its functions, Commodity Future Market, Forward Contract Act, integration with SEBI, commodity derivatives, and then we have the summary part. All right, so these are the topic we are going to cover in this particular series. All right, so let's start with the FMC. So basically here, by the definition and the full form, you could understand that FMC stands for the Forward Market Commission. So if the question asks you that FMC, it stands for which? Okay. And the two options are given like future market commodities. Okay. Like the forward market commodities. Okay, so these are the two options given over here. All right, so if you just look at them, you will find it future market commodities are very relevant when we come to the forward market commodities. Okay, by perception or by normal psychology, you can say. All right, but if you go by the definition properly, which stands for the forward market commissions, thereafter you will mark only that answer, not this answer. All right, so please keep this thing in your mind that FMC stands for the Forward Market Commission, not for the Future Market Commission. Sometimes I have heard it from many people that they called it as a future market commodities. Okay, why? Because when we go further, you will find out here. You can also see like the future. Okay, future word has been connected with this thing. All right, so many times people got confused and mark future market commission. Okay, and here we have done a mistake. All right, it's not commodity, it's basically a commission. Okay, future market forward market commission. All right, got it. So let's start. First point we have, the Forward Market Commission was the regulatory authority responsible for overseeing and regulating the commodity future markets in India. All right, it's the regulatory authority. Okay, all right, it is here. All right, it is the regulatory authority. It means it's having some rules and regulations power empowered with itself so that it could regulate the certain area. Okay, which areas? Responsible for overseeing and regulating the commodities future market in India. All right, commodities future market in India. Okay, however, please note that there have been significant developments in the regulatory framework in India and the FMC has undergone changes. All right, however, by this definition you could conclude that the Forward Market Commission, FMC in short, is the regulatory authority which is responsible for regulation and overseeing of the commodities future markets in India. All right, but because the Indian economy is growing up, because there are so many changes introduced year by year in the economy and other aspects, that's why there might be some changes and developments in the FMC, which the FMC has undergone changes. This line I particularly mentioned here because FMC is subject to the current affairs. Okay, so for better understanding of the FMC, you have to keep yourself updated with the regular and proper current affairs ongoing on. Okay, Now, after finishing the general definition part, let's move to the regulation. Okay, this part, regulation. So first step is here, establishment and jurisdiction. Okay, so let's go with the establishment. Forward Market Commission was established in the year of 1953 as a statutory regulatory body under the Forward Contracts Regulation Act 1952. Now here we have got two things. First is the establishment year, and the establishment year is which year? 1953. All right, 1953. Second thing we have got here is the act. Okay, so basically the act is Forward Contract let me write down again, Forward Contract Regulation Act 1952. Okay, so please remember the two things. First, the establishment year is 1953. Okay, second, the act was Forward Contract or Regulation Act 1952. Okay, so there are the two things. Got it? Keep this thing in your mind. The act was not like the Forward Market Commission Act. Okay, maybe it was given in the options. When you face the examination, there are chances that it will be given in the options that the Forward Market Commissions have been established through Forward Market Commission Act, which is not true, because Forward Market Commission Act is nothing but the correct act is Forward Contracts Regulation Act 1952. Okay, so keep this thing in your mind. Second, its primary objective was to regulate and promote the commodities future market in India. FMC has jurisdiction over all recognized association and their members engaged in futures trading of commodities in India. All right, please note this thing, future and future. Okay, so basically the Forward Contracts Regulation Act was the responsibility to establish the FMC, and it's basically to regulate and promote the future markets in India. Okay, but there is one thing which I would like to tell you. It's like, what do you understand by future market? Like, what is the meaning of future market? What do you understand by it? It is the first thing which we should discuss before we proceed. Okay, so you can say future market is basically deals with actual contracts or obligations signed today but having legal force on tomorrow or coming future. Okay, so remember, future market is a market which deals with the actual contracts or obligation which are signed today but having legal force on tomorrow or for coming future. For example, suppose let's take an example of contract. This is a company XYZ. Okay, the company is basically for the car company, okay, which sell out its car in the market. This company XYZ, and this is the company ABC. Okay, this is the contractual manufacturer. Alright. So XYZ is the company which is selling the car in the market, while ABC is the contractual manufacturer. So suppose it signed a deal with the ABC that the ABC should deliver 50 car models or manufacture 50 car models for XYZ. Thereafter, once the car models will finished off, the ABC will deliver it to the XYZ. Okay. Thereafter, the XYZ will sell out these 50 car models under their name. Marketing and other types of things will be handled by the XYZ. The contract is just for the manufacturing of the car models. Okay. So this is the contract. Alright. Suppose if this contract was signed on 1st January 2005. Just take an example. Okay. So it is not feasible that on the same day 50 car models will be delivered off. Okay. So we can say that a particular time period will be granted off during the agreement. So you can say from 1st Jan 2005 to 31st December 2005, these 50 car models should be delivered, okay, to the XYZ. Got it? So now you can say the contract was signed on the previous date, but it's having the legal force in the coming future. Okay. So here you can say it's an example of forward market or the future market. All right. Means the 50 cars delivery should be done in the future, not on the same day. Okay. So here are some dispute also. Suppose when the 50 cars deal was signed, so you can say per car value was rupees 1 lakh. Okay. So you can say 50 cars will be sold out at rupees 50 lakhs. All right. But it was the value on 1st Jan 2005. When we talk about the 31st DEC or 31st December 2005, due to the inflation and whatever the other causes, this 1 lakh rupees has been rose up to the rupees 2 lakh. Okay. If we go by this, then the 50 cars must be cost at rupees 1 CR or 1 crore you can say. Okay. So in such a case, the ABC might claim that because we have to bear the 2 lakh rupees manufacturing cost, so the price 50 lakhs will not be redeemed, but 1 crore is the asking price. All right. So in such a case, the FMC will act because it said that everything, the price and other related aspects, all are signed in the future agreement. Okay. So you can say doesn't matter what the price on the maturity, only the signing price will be considered of. Okay. So this is the example of the future commodity. Got it? So we can say future commodity market is a market in which the contracts and the obligations are signed off for the coming future. Okay. All the price related information has been signed in the particular document and nothing could be changed off. Okay. Got it? Now come to the topic. Thereafter, what we have the Ministry of Finance oversight. FMC operated under the administrative control of Ministry of Finance. Okay. So please remember here what we have seen. The FMC is under control of which? Ministry of Finance. So it is the parent ministry of the FMC. Got it? Second thing is that this place within the Ministry of Finance provided it with the necessary authority to regulate and oversee the commodity futures market effectively. All right. Because the Ministry of Finance basically deals with the expenditures and revenues. All right. So that's why FMC also indulge in the agreements which are the part of expenditure, and the revenues. Okay, so because of this, their indulgement with the Ministry of Finance provides them with the necessary authority to regulate and oversee the commodity futures market effectively. Got it? Now let's move forward. Second is recognition of commodity exchanges. FMC was responsible for granting recognition to the commodity exchanges in India. Exchanges needed to meet certain criteria and regulatory standards to gain recognition. Okay, all this kind of agreement, all this kind of things comes under the agencies. Okay, and these particular things required a recognition from the FMC, or you can say these are some sort of licensing. Got it? Licensing is basically signifies the recognition part. Okay, like if the particular thing having the license, it means the particular thing has been recognized by the appropriate authority. Same thing happens here. Okay, so the FMC was responsible for granting recognition to the commodity exchange in India. Exchanges needed to meet certain criteria and regulatory standards to gain recognition. Okay, so here derives a question. If the question asks, which of the following having the power to give recognition to the Commodity Exchanges Board in India, the answer should be FMC. Alright. Thereafter, the legal framework, like every organization, regulatory organization which is operating within the country must require a legal framework on the basis of which it could drafted the policies, the rules and regulations, and supervises the things. Okay, so when we talk about the FMC, the question is, what is the legal framework which empowers the FMC to exercise its powers? The correct answer is the FMC operated within the legal framework of the Forward Contracts Regulation Act 1942. Again, I'm telling you, if the question is giving like the Forward Market Commission, FMC, or you can say Forward Commission Markets, whatever will be there, please do not take the answer correct. Why? Because the answer is totally wrong. The main article, or you can say the main act was Forward Contracts Regulation Act 1952. Okay, and the rules and regulations made under this act, these are the legal framework behind the FMC. All right, so basically here we have finished this one and this one. Okay, now it's the part for functions. Okay, so let's look at the functions and the powers. First is regulating and overseeing commodity futures exchanges. Okay, so regulating and overseeing commodity future exchanges, FMC was primarily responsible for regulating and overseeing commodity future exchanges operating in India. Commodity exchanges provide a platform for market participants to buy and sell commodities, derivatives, including future and options contracts. All right, so primarily responsible for regulating and overseeing the commodity futures exchanges. Okay, and provide a platform for market participants to buy and sell commodity derivatives, including the future and the contract options. Okay, FMC's regulatory role involved ensuring that these exchanges followed the rules and regulations set forth in the Forward Contracts Regulation Act 1952 and the other relevant guidelines. Okay, the Commission monitored the exchanges' compliance with these rules to maintain the market integrity and the investor confidence. All right. Thereafter, what we have? By regulating these exchanges, FMC aimed to create a safe and transparent environment for trading and the commodity derivatives, protecting the interest of market participants and the preventing market manipulation. Okay. Now, the second is formulating regulations and guidelines. FMC was responsible for formulating regulations and guidelines that govern the functioning of commodity future markets in India. These regulations covered various aspects, including contract specification, trading procedures, margin requirements, and the risk management. Thereafter, the Commission played a crucial role in shaping the regulatory framework that underpinned the commodity derivatives markets. These regulations were designed to promote fair and transparent trading practices, reduce risk, and facilitate efficient price discovery. C part is that FMC had the authority to monitor and supervise the conduct of commodity futures trading. This involved effectively tracking trading activities on the exchanges to identify any irregularities, market manipulation, or unfair practices. Okay. Monitoring was a proactive measures to ensure that market participants adhered to the principle of fair trading, involved real-time surveillance to maintain market integrity. FMC had the power to take action against any entity found violating the rules, which could include penalties or suspension from trading, or you can say basically revocation of license granted by the FMC. All right. Thereafter, D part is that protecting the interest of market participants. Okay. One of the FMC's core responsibility was to protect the interest of various market participants, including hedgers, speculators, and traders, aimed to create a level playing field where all participants had equal opportunities and faced minimum risk of unfair practices. FMC's actions such as setting margin requirements and regulating position limits were designed to ensure that the interest of market participants was safeguarded. By doing so, it contributed to the market stability and reduced the chances of defaults and the financial losses for traders and investors. Okay, so students, here we have finished the FMC definition, regulation, and functions. In the next lecture, we will continue with the Commodity Future Market, Forward Contract Act, integration with SEBI, commodity derivatives, and the summary part. Alright, till then, just revise all the facts and figures we have discussed in this lecture and be ready for the another lecture to avoid the any type of compilation of the facts and figures you will have in the end if you do not revising the things on the proper basis. Okay, so with this note, let's end this lecture and we say thank you.